We are live. This is Value After Hours. I'm Tobias Carlisle, joined as always by Jake Taylor, our two special guests today. You know it's a big deal when it's a four-square. Porter Collins and Vinny Daniel from Seawolf Capital. How are you, gentlemen?
We're doing great.
Doing well.
So good to have you on board.
Angry as always.
What is making you angry?
Yeah, that's a whole segment we can do.
When you run a long short portfolio, you're only angry at all times. So
that's it. There's always something not working.
Something not working at all times. So, but it's good. You know, it's you're always frustrated at something. You know, when you find a turn in a sector, trying to find the right one to pick, and then then you pick the wrong one or whatever. Something's always driving you crazy. So
just before we got on, we were chatting about Rivian. Rivian's got this innovative business strategy where they're spending, it costs them $150,000 to make a car, which they then turn around and sell for $83,000. So I think my instinct about getting one of those was right. That's good value. But is that a good business strategy?
Well, it is in this day and age, right? It seems to be at least from a stock market perspective, it's been a pretty damn good strategy over the last few weeks. And prior to going live, we were joking around. I got to give Porter kudos. About 2 weeks ago or so, we bought a really small position in Rivian, which is just not something we do. I think Porter was, going through the coastal Connecticut and saw a bunch of Rivians like the truck and said, "Hey, why don't we buy some of this?" The old Peter Lynch model, is it?
Yeah.
Is it correct?
Right.
And sure as heck, I think the stock was up, 50% for us for no reason. Now I know what it feels like to be on the other side of one of these short squeezes where it's like, wow, they could just go up and up and up with no basis or background other than that it's a heavy short interest.
Well, a couple of years ago, I had listened to the How We Built This podcast, and the CEO was on there, and I loved it immediately. Like, the guy went to RPI, then went to MIT, and like all he wanted to do his whole life is cars. And he graduated and got his PhD, and the first thing he did was start Rivian or whatever with the predecessor Rivian. And so I respected him a lot, and so the stock was bombed out. And listen, they're selling their cars now, and they're selling the vans, and they're starting to ramp up. Anyway, but the stock went up, $10, and we sold it.
How'd that annualize out?
Yeah, that's something we never do. But in the one of the most speculative markets of all time, we got a little speculative. So,
is it 2021 again? Are we back in the good? 2020, I guess, back in the good old days.
No, because the liquidity is not there.
Yeah,
the amount of liquidity is not there, and I think the valuations were even dumber at that point, right?
There's some pretty dumb valuations out there. But yeah, that's probably right. They were dumber.
Yeah.
There are fewer. We don't have the SPAC activity that we did in 2021. You don't have the massive issuance. You don't have. It's really, the stupidity that we see, I think, is isolated to, just a certain cohort and sector of stocks. It's not, as you guys know, being value guys, it's not everywhere. There's actually a lot of things that are not necessarily that expensive at all. In fact, some of them are quite cheap. It's just the money's not flowing there at all.
Well, let's talk about that a little bit. What looks cheap to you? What do you like? What sectors and industries? I guess don't have to name names if you don't want to do that.
You want to start, Porter?
We've been doing a little bit of dumpster diving in financials. We've liked energy for a long time. We've been buying more energy recently. We argue a lot about the gold miners and the gold stocks. The problem is, it goes back to that a lot of these miners, whether it's gold or uranium, they're just not optically cheap stocks. Actually, there's not a lot out there that's optically cheap. A lot of it, we were going back and forth earlier. One of the names we like the most, we can go through a little later, is the gap and adjusted differential between numbers. And, how do you think about that? How do you sort of wade into that conversation and make a rational decision? So, listen, I don't think there's a lot of cheap stocks out there per se. The the energy names, I think, have always been cheap, and I still think there are a handful of them out there that are super cheap. So that's kind of what we're looking at.
We get a question about the gold miners, gold and the gold miners. Do you have to have a view on gold to have a view on the gold miners here?
100%.
100%. 100%. They will not move without a positive rate of change of the underlying physical, or at least I would consider myself lucky if I own the miners, gold went down and the miners went up.
We're taping this on Tuesday afternoon. We have a big CPI print tomorrow morning, Wednesday morning, and so if the CPI is under 3%, I think people are going to be of the opinion that the Fed's done, even though that's the total CPI. The core CPI is still something like 5, right? Ex food and energy, still like 5. But
you think that even though like Powell seemed quite direct when I saw him get asked that question. He said basically two more hikes, and the market seems to have priced in at least one of those hikes.
Yeah. What does priced in mean? Like what the bond market, the equity market?
That's a good point. That's fair. There's an expectation, I think, that the first one priced in the futures market, but not so much not in equities, not in bonds.
To be fair, the futures market is wrong 100% of the time.
The interesting part of all of this is that, over the last, say, month and a half, rates have increased, right? And in general, as rates increased, you would expect to see a decline in any long duration tailed asset of any kind, right? And you've seen just the opposite, right? Particularly forget about the Magnificent Seven or whatever you want to call it. Let's all consider most of them great companies. They've worked fine. I'm talking about the crap shit, right? Like the crap shit has ripped, like all of it. And it just says to me, for the time being, and subject to change, obviously, that the short interest algo is far more powerful than the higher rate long duration algo. These things are not supposed to go up when rates rise. These things are not supposed to go up when real yields are increasing. Yet they go up every day, like impressively every day. So it'll be interesting to see if tomorrow brings a change in the dynamic. Who knows? We'll find out.
Do you think that's a result of the Fed did drain a lot of liquidity away, and then SVB and FRC and those other things got into trouble, and they half of it came back out, and they now seem to have drained back below where they were before SVB?
Well, we talk about it before, and it goes back to what they did in the gilt crisis. The UK went in and did QE again, right? And that coincided with the bottom of the market, right, in October. And then I think that again, another bottom of the market was when SVB goes down, and not only do they provide support, but they you can take all your collateral to the Fed, and get 100 cents on the dollar for it. And so there was a lot more liquidity than you saw, on the headline number. And then, we're still running massive fiscal deficits, right? And was it 6% fiscal deficit? We got the CHIP Act in there. We got the Inflation Reduction Act. So there's so much stimulus, and I think that's why the market's going up. So listen, we've sort of missed all that fancy tech trade, and we've been short some stuff, but thankfully not all the magnificent seven. So it's gone crazy.
Let me just give a shout out to the crowd, fellas. We've got Philadelphia in the house, Brandon, Mississippi, Huntington, Yorkshire, Dubai, Moncton, Santo Domingo, Dominican Republic, Bendigo, Victoria. What's up, Belgium, St. Louis, Cardiff, Wales. Boys are back. Tallahassee, Madison, Orlando, Florida, Pune, India, Madrid, Helsinki, Vienna, Jupiter. What's up? All right, Yosemite. Yeah, me too.
I saw that the 30-year U.S. mortgage crept up to 7.38%.
It's getting better.
That's back to kind of historical norms.
For us, yeah, historical norms without the historic norms of valuation of the underlying collateral, right? Like to me, that's the big deal that people miss. Like you hear some of the old timers say, well, rates used to be at X and we lived. I go, yeah, but the price of a home was 20% of where we are right now. It's a material difference. For us, for me, rates are, given how financialized we are, given how levered we are, and given how high valuations are in underlying collateral, rates are the leading indicator, the way I think about it. And so as that goes up, the ability for anyone to buy a home, to buy a car, to buy a piece of commercial real estate just declines. The value has to come down absent you paying up in a material manner and putting your cash flows, or at least at risk. So as we were talking about it, I actually think many of the leading indicators are in yellow signal, stressing yellow signal right now. The market, for whatever reason, is ignoring it. There might be reasons for that. We could get into that, but in general, I think in the near term, if this continues, if rates stay where they are, I just think you're going to see tougher economic conditions coming over the next 3 to 6 months. It's hard for me not to see that.
And if you think back to our big short trade, why was it different this time? I think that, we saw what was the 228 mortgage, all the resets were going to come from the 04 to 05 cycle. We're going to reset to the base rate. And, the Fed had hiked, I forget the number of times in consecutive quarters, it's like 20 consecutive quarters they'd hiked. And so rates were a lot higher. And I think that I'm guessing that you're going to see it first in the places where they have adjustable mortgages, your home, Australia, Canada, UK, where inflation is still a real issue. Rates are a lot higher, and a lot of these mortgages are resetting higher. So all else being equal, your disposable income is getting cut pretty significantly, and home prices, especially in Australia, are significantly overvalued, and the debt service coverage looks pretty poor. And so, listen, if I had to guess, Australia hasn't had a recession since, I don't know,
1990s. 1992.
Yeah.
Toby was a kid.
And so, if I were a betting person, I don't have this trade on, but I think you could see it there first, a recession there first, rather than the US.
The tension is clearly between those people who think that housing is overvalued given where interest rates are, and their expectation is that interest rates fall back to where they were, and so housing doesn't have to do anything. And other people who kind of take Powell at face value, that he's looking at inflation still running pretty hot, employment's still looking pretty healthy, even though it's a lagging indicator, and that gives them plenty of room to keep the rates up. And so if Powell keeps the rates where they are, then housing has to come down, risk assets have to come down. If he panics and does what just about every other Fed chair has done and pins them to zero, then we're back to the races, right?
Yeah, I think that's fair, but he can't pin them to zero without something happening.
Pin them low. Yeah.
Well, or even let's be more rational and realistic and say rates would gravitate towards 3% Fed funds. He can't do that without some form of stress occurring in not just the economy, but probably in markets as well. So I don't know if you're going to get the super Goldilocks, right? Which is I could bring rates to 2 to 3% and the market is going to stay where it is and therefore go materially higher. Now, bull markets have done things that I never think that they would do, but that just seems too Pollyannic of an outcome. It's possible, but it's not. I don't think it's anywhere near probable. So.
Is there anything like with the Big Short where there was a catalyst with a known kind of date to it where like, okay, all this is going to go, sideways on this date? Do you have anything that you're seeing that might be a candidate for a reckoning at a particular time period?
Vinny seems to be smiling, so I don't know. What do you think about that?
No, where's the issues, right? The issues are in the sovereign, right? And so as a result, there's no timetable. Whenever something bad happens, they cave in and they print. And as Porter was saying, they did that in October of last year with the UK. They did it in March with
How about the debt ceiling,
right? They did it with the debt ceiling. So the big issue for us is that, yeah, you could have idiosyncratic pockets of issues, but nothing, so it seems, can be material enough, because if it is material enough, like unlike the last time during the Great Recession, I truly believe that the Fed did not know what a lot of the people who were looking at the underlying banking system knew. They didn't know how severe it was. Now they know, and they're on it. I mean, Credit Suisse goes under, and they're flooding the system with dollar swap lines to make sure that nothing associated with Credit Suisse is going to impact the rest of the world. So to answer your question, yeah, there is something out there, and there probably is a definable date. The debt ceiling was a definable date, but what do? You just change the rules and print more money or keep the thing afloat.
What about like an Airbnb bust? Like I follow a few of these accounts who think that there are a lot of people who are extended on these things because they're looking at them as a cash flowing asset, and they assume X amount of occupancy and, wherever they are.
There is no catalyst. What's the catalyst though?
Well, you just can't make the payments. There's not enough occupancy to sort of,
if they lose their jobs, if and when they lose their jobs, then I think that'll be, the cascading effect. But
what about corporations saying you got to come back to the office now?
But that's not material enough to really bring
as a trigger for the Airbnb bust.
I think Porter is right. Like, employment is probably the next big catalyst for the Fed. Like, we could get a benign inflation print tomorrow. Who knows, right? Like how they calculate that crap. I don't think that really materially changes the Fed's intent. Like, meaning they're probably still going to go 1, maybe 2. Right? I don't see them going more than that, quite frankly, because I think something would crack if they continue to go, really crack, like we did in March. But I think they'll materially change their tune to the more dovish variety once employment shifts, whenever that occurs.
You look all around the world, inflation's still really hot. I mean, Brazil's the only place that doesn't have hot inflation right now. And their rates are 14%.
Although the leading indicators are suggesting they're coming down, Porter.
Rates are coming down.
No. Even if rates of inflation are coming down. Right?
But look in the U.S. is still ex food and energy at 5. That's too high for that. That's higher than the Fed wants.
Yes.
And they are scared about the lag effects. Once you lap the easy comps, you still have a wage spiral, right? Because I forget that UPS is having the contract negotiations. I think Delta Airlines just did. Like, a lot of these guys
starts getting structural.
Yeah, the unions are powerful once again for the first time in a long time. Look at the UK. I mean, I think their minimum wage is like $25 or something like that. And they just keep ratcheting that higher to afford the property.
When you look at energy, so Michael Cow has this. Michael Cow had been a little bit bearish on oil as he's like, I think the thesis is something like there's a recession coming. Energy tends to not do as well through a recession. Therefore, these marks have got to come down. He's probably been saying that for 6 months. I hope I'm not like 6 months or more. And it seems to have been, pretty right so far. Like, what does it take to get? I asked this like fully disclosed. I'm up to my risk limits on energy, so I'm interested to know.
Tell me why I'm right, please.
I think there's 2 things, and they're pretty powerful. One was the weather was very benign this year, right? It was a call it 2-3 standard deviation event in terms of a warm winter, right? And so you saw gas prices collapse right in December, and then 2, you had the SPR release. And
that's still being trained, I think.
No, I think they're done right now. Okay. And so, that the SPR is done. The weather is at least normalizing, right? So so far it's been a warm summer. And then you have OPEC cutting, and you were still waiting on China's stimulus, which may or may not come, but it's a benefit. So, I've said for a while that I think, both gas in the US and oil have probably bottomed. And, these stocks are doing a little bit better. And there's a guy on Twitter that has all this data going back to like the 1200s. And, basically all the commodities are correlated. And I think oil is the granddaddy of them all. And as oil goes higher, so goes everything else. And so, they've all been correlated down. And then, whether it's copper or any of these things. And so I think as oil goes higher, you're going to see more commodity inflation. And I'm not calling for $120 oil at all. I'm just saying, the bottom is probably in and, biased higher.
I think you started seeing bottom. Let's rewind the clock 6-9 months, right? When he initially made his call. As Porter said, yeah, the SPR release, you had CapEx increasing, rig counts were going up. You had phantom supply coming from Russia above and beyond, and other places above and beyond. Some of these still exist, but the underlying price of energy bottomed once the rig count started, like the second or third week when U.S. rig counts started to decline in a material manner. You saw Natty and all that just stop going down, right? It would, and then from there, I joked around that you'll probably see the bottom in Natty the minute Rafa puts up the serve at the French Open, right? And
He's right.
While Rafa didn't play, that was pretty much it, right? And so we'll see. I mean, weather needs to happen, but you've once again reduced CapEx in fossil energy. So you're not, even whatever supply you were getting, you're not getting as much as you were 6 to 9 months ago. So
we've been very bullish on offshore drilling and all that type of stuff, because one of our biggest positions has been Petrobras, still is, in the energy giant in Brazil. And most of their drilling is all offshore, and they're going hog wild in terms of trying to drill and putting up new contracts for these drill ships. And so that combination, the Tidewater has done really, really well. Some of these names have moved a lot, but Petrobras is still an incredibly cheap stock. Mid-20 dividend yield. 4 PE, however you want to value it, and I think the macro in terms of emerging markets is looking as good as it's been in a while, and so over domestic markets at least, and so you have the Selic rate, they hiked from I think 1 to 14, and interest rates are now at 14%, and inflation is down to 3. And you finally have that dynamic working, and the currency's done very well. And so I think when you get these inflection points in the macro really right, they were upgraded by, or they're put on a credit watch upgrade by S&P. And if you go through and read that report, it talks through all the dynamics of, why that the yields can come down, why the currency can strengthen. And so, I think that, when that happened, you saw all these Brazilian stocks kind of move higher.
What do you make of the strength of the consumer in the US? Seems like there's a lot of discretionary spending around on, travel in particular. Not so much, I guess, in retail, because retail, we got a print this morning that said that same sort of sales were down year on year. But the travel seems to be people spending a lot of money. We had the biggest weekend ever, I think, over the July 4th weekend.
Let's paint the bullish current picture right now, if we can. One, unemployment's really low, right? And I'm talking mostly domestic right now, US. Unemployment's really low. Wages are still pretty favorable. And if you own your home, chances are there's a very, very good chance that your mortgage rate is fixed and below 4%. And I also heard from people that are not in our business, but it makes sense that work from home has saved you a heck of a lot of money commuting. All of that has probably increased discretionary income to the point where and pent up demand where you can go out and travel and people have wanted to live. How long that lasts, or at least the rate of growth on that, I think is the real question to me. But that part of the consumer has been strong. What has not been strong are big ticket items, right? Aside from travel, the big ticket items of an auto, of a house. The home builders, as you guys probably know, has been an incredible, sadly we missed it, thankfully we weren't short it, has been an incredible place for alpha this year. And it's a really, truly bottom-up story. But when you think about the amount of new homes that are sold in the country versus the amount of existing homes sold in the country, the overall aggregate pie of homes being sold, the transaction velocity is down, right? And so as a result, housing overall is not doing that well. Auto overall is not doing that well. The new OEMs are beginning to incentivize because many people can't afford or want to afford $1,000 monthly auto payments. So those big ticket items have suffered at the expense of, I think, of travel. So I don't think the overall consumer story is like super robust. I don't think it's weak. It's just pockets of spending has shifted.
And the TSA numbers are flat with 19. It's just that the prices are up a lot more than they were, which is great for airline profits and all that kind of stuff. And that's why, it's amazing if you look at these charts of the airline that, as of mid or early June, they had done nothing. And then they just basically skyrocketed in the past, taken off in the past month.
It's expensive every time I get a boat on.
Oh my God.
They're gouging. The housing was the home builders was a really strange one because, they all came into the screen. I did hold a lot of those in the things that I managed just because they were unusually cheap. But I was as scared about that as anybody else was because I could see that I thought we were going, the recession would hit those pretty badly. I didn't see that everybody would get trapped in great mortgages and then that would squeeze out into the new homes and they'd have this absolute bonanza period.
I think that the amount of people in the world that had that thesis was like 4 or 5, right? Not many people had that, we knew that you weren't going to be able to move, mortgages, but who knew you'd be, the new wholesales would just rip. And that's because employment stayed strong.
Porter, I got to give a shout out to our friend. So about 6 months ago, we do these idea meetings, right? And arguably probably one of the best stock pickers we've ever met. He does mostly financials. I'll give him his name, Jordan Heimowitz, if you guys know who he is. He runs a fund called Philadelphia Financial. Pitches the home builders to us, right? And I forget exactly if he had the exact theory of which played out. It doesn't really matter. I think his theory was from October, rates were down 50 basis points and the slight rate of change of improvement in home builders, even though it was a poor seasonal season, not many people buy homes in the winter. Nevertheless, these stocks are going to work. He nailed it, right? And I remember saying to him, I'm saying, kind of like you, Tobias, this doesn't fit my eye, right? It doesn't fit my brain, but knowing it's you, it's probably going to work, right? Yeah. Because the things, you're just that good where things are going to work for you. And sure as shit, it worked. What do you do with that?
And knowing us, we didn't buy it either.
We didn't buy it. But we didn't short them. We didn't short them, right? What you do from here with these things, I don't know. Like I can't buy these charts that look like this. They're not like, if you look at the historic ranges of where these sit, and I like to look at the builders on a price to book basis, right? They're not incredibly expensive yet, but they are no longer where guys like us want to sit and go buy them if we could get over.
Yeah, you got to be smart. You got to know what's happening at this point.
Yeah.
It's a different bet for sure.
Different bet. Very different bet.
And there seems to be a lot of supply coming on from the new home builders too.
Yeah.
Like I think I saw, these numbers are going to be wrong, but I saw like 1.6 million homes are being built in and if you look at, I think we're transacting at like fewer than 1 million at the moment.
That's just LA. I'm just kidding.
Nothing gets built in LA.
We are structurally short housing still.
Yeah.
As a country.
Yeah.
Yes.
I always wonder about those. I think that that's right because we can see how there was so little building going on in the aftermath of the GFC, And we seem to have been underbuilding by like 500,000 homes a year, something like that, for an extended period of time. And at some point that has to catch up, and maybe that's now. But I always wonder about...
We've made up the difference in multifamily, which a lot of people don't consider. But I also don't think, I've also thought this country as a whole has done a poor narrative job of the rent versus buy equation for people. Like it's not the end of the world if you're renting, but nevertheless, I agree with the other parts of the discussion in terms of, we're short homes.
I just wonder what that seems that structural shortness of homes seems to go away every time there's a bust. Like, the rental vacancy is spiking at the moment. Rental vacancy is getting back to sort of where we were. It's back above 2017, 18, 19.
Well, I mean, a lot of the consumer metrics aren't great. The credit card delinquencies are back to nearing 08 levels. Same thing with auto
bankruptcies,
delinquencies. Yeah,
I was adding bankruptcies in there as well.
Yeah, I haven't looked at the bankruptcies, but I don't think so. It's anywhere close to that. But and then you think about commercial real estate, it's also not good, right? So great, the Fed's going to hike 2 more times. That's not good for any of those underlying metrics. And so, it's hard for me to get super bullish about what's going on. But again, we're doing our usual dumpster diving in places where we like, right? Where we there's a couple of different financials, which there's two. We have 2 financials. We have a handful of energy names. All it takes a couple with a couple nice catalysts and inflection points, and that's how we tend to make money, right? Buy well, and hope for a nice little catalyst, and hopefully have good management team along the way to help you out.
Do you feel like that implies that it's like this next perspective, call it year or 2 years or whatever, is likely to do well for guys who are a little bit more stock pickers and not so much just riding a tide?
I would have said that 6 months ago. And
yeah,
absolutely.
Whole career.
I always laugh at this question because it's like this, if you ever watch golf, they always say it's a ball striker's course. Well, what isn't a ball striker's course, right? Like, and my view is, it's a stock picker's market. Well, it's now going to become a stock picker's market. Well, tell that to the person who had Nvidia for the last 6 months. He thought it was a stock picker's. He or she thought it was a stock picker's market. It just happened to be not the stocks that we tend to like, right? Like Druck had it. So in that regard, I don't know. I prefer to think that there should be opportunities all over the place at some point, long or short. It's just our job to find them. So,
we were doing some work on Alibaba recently.
I was going to ask them this question.
Yeah, because you look at the valuation and it's back to 10 times earnings. The sales have been pretty good. Sales have been great actually. And they've run into a steamroller. What is the Communist Party, and they've paid their fines. And I think they both Alibaba and Alipay have paid their fines most recently. And so you start to wonder, hey, if they're through this, and there's a little bit more China stimulus, maybe that's the type of stock you can buy that is not a normal value stock, right? Apple got to 10 times, Meta got to 10 times, maybe that too. And we were just kind of trying to go and, go through it. And we, Vinny did some modeling on it, and we own a little bit and, wait it out here a little bit, see how it goes.
Does the ability to kind of collect on the bet concern you? Like, that's the main issue, isn't it? Whether you can, like, the nature of your right as an American holder of some sort of offshore entity that then invests derivatively into the underlying, like you don't have this direct right like the way that you do in the States where you hold a share. You can
the way we handle that is, generally speaking, sizing the position. Clearly a risk, right? So could I ever envision Alibaba being our largest position? No
way.
And because of that, right? So what I like to do is say, okay, what percentage of capital would I have at risk in this single stock? based upon that risk, which you could wake up tomorrow morning and you could be down 60% just because of what you said. So it will never be at the top of the pile for us. That said,
but that's been a risk for a long time, right? And you've gone through a lot of the risks, right? The Chinese government coming after them, and Jack Ma being vanished to wherever he is, so and you've taken a lot of those hits, and that's the reason for the discount now at this point, right?
He's teaching somewhere now, Jack Ma.
Yeah, I mean, for what is arguably one of the better, more well-run companies in the world, right? If you look at versus Amazon, you could have a very good intellectual discussion that Alibaba is better run or more profitable at least.
Yeah, I bought Meta when it kind of troughed and got
you
beaten
did.
up.
I think the last time we were on, you were buying Meta.
To be fair, I bought it. I bought it before it got really, really cheap. I don't know exactly where we started, but we bought it all the way down. But I like, something like Meta. I feel like you could do that. You're betting on Zuck coming to his senses at some point, because quantitatively it was stupid cheap. But if they keep on spending in the metaverse, that's a word I haven't heard for a while. Spending in the metaverse.
Someone got to him. Someone got to him really early and intelligently well. And he turned metaverse into AI and combined with just the normal business, which you're right, it was stupidly cheap given the margins and the cash flows. So good call on your part. We did a similar thing. It wasn't as impactful when Google came down. I sort of had Meta envy, and I said, well, why can't this happen to Google when it got into the 90s? I did not see the upside that Meta had, nor do I see it as well. But when those businesses come cheap and for sale, I think it's kind of our job as value-oriented people to really take a hard look at it, because they're great businesses, and you rarely get an ability to buy them cheap. Something's usually wrong. You're not going to be able to buy Nvidia cheap unless something materially goes wrong, right? And then we have to assess and underwrite and see whether it fits our process. So.
What did you make of that whole, the announcement, the Jensen Huang, whatever it was, the earnings call or whatever it was, where he came out and they, the year on year, the sequential revs were down a little bit. And I understand he's not at all a promotional CEO. He's a conservative-ish CEO. And then he said 7 billion to 11 billion.
I think people would debate you on that one.
Okay. I'm not that close to it. I just got I understood that like him saying 11 billion was pretty much like they're going to hit that number.
Well, they're getting a lot of price too, right? They're getting a lot of price and a lot of volume, and so those two. I would suspect the next couple of quarters are going to be really good. After that,
yeah.
But let's see.
My concern would be more the longer term, not the near term. As my guess is, every newly minted VC-backed entity has something to do with AI. That combined with larger entities just buying whatever chips they can get to put together some form of AI, policy or strategy for the company. So
it's crazy that Intel
every board's asking, "What are you doing?"
What's that?
I was just saying, every board is asking, what's our AI plan?
Yes.
I just think it's crazy that Intel can't figure themselves out here. Intel is just like, I owned it.
But they're so into the PC market, which sucks. Right. And that's the other thing. It's like, look at Apple's sales. Like, I know Apple's done great as a stock, but the sales aren't good, right? The handset market's not great. The PC market's not great.
Yeah, I'm not sure this is the reason why Intel has sucked. And I agree with you. We've tried once or twice to own it as well. But that CEO's initial compensation package for not doing much of anything can make you want to vomit, right? It's just a hard thing to swallow when you see that much money being made without any material improvement in the prospects of the company and the stock. So
I saw Tavi Costa had this tweet about the amount of market capitalization that whatever we're calling them now, the Magnificent Seven, Fan Mag, or whatever what do we finally settle on there for those guys? But he said they're at like the market capitalization as a proportion of the S&P 500 of the biggest 10 stocks he's saying is 31.7% as of June 30, but their earnings contribution is 21.5%. So they're, they're occupying a materially bigger part of the index than they're actually earning, which would seem to suggest to me that at some point that reverses.
Maybe. That's not a game we play in, we try not to mess with that. We don't do much in the like, try not to look at the market that much. We just try to find stocks that we like and stocks that we'd like to short. So
what about NASDAQ, largest 5 positions, I think like 48% of the NASDAQ 100. I sort of think from Bill Nygren where he said, they're so concentrated that they might lose their diversification issue, which is part of the reason why I think they've been taking down some of those positions. They're not market capitalization weighting them. They're doing something else to them now. I don't know how they're going to treat it, but there's some change coming up.
Listen, you can feel that these stocks are just exhausted, right? They had that move, I think it was mid-June, like on the rebalancing, that they were just going straight up every day. And the amount of billions added to, or trillions added to the market cap just in random trading, it was too much.
Yeah, and it gets back to a prior conversation we had. That becomes a function if you believe in the whole the ETF phenomenon and passive, right? Employment and the money coming in the door. It's only going to the top cap weighted names, or at least a good portion of it. And that combined with momentum strategies, employment becomes an interesting dynamic when it comes to markets if unemployment ever got materially bad. And then I think you would see those names sell off for reasons like, why are they selling off? Well, you just don't have the flows coming in the door anymore. I'm not sure if we get there or how we get there, but I do agree with you that, we're at levels right now where if I was someone who owned them, and I think you referenced it, I even think NASDAQ is concerned and are changing the weightings of it because it's just the concentration is really too high.
I prepared a special little piece for you guys specifically that's all about intuition, because I feel like you guys have pretty amazing record of intuition of things. So I was wondering if I could go through that now. And
oh God,
this will be good. It actually started with a conversation I was having with a quant-minded friend of mine, and he was saying that it's almost any famous investor or a successful investment strategy can be codified into rules and then run as a quant portfolio, and therefore, which means it's likely to be arbitraged away at some point by computers. And so what he was saying is that like real alpha now is when a fundamental qualitative investor actually goes against their own rules, and which implies that you have to have some intuition about what causes you to deviate. And then now it's a skill to know when to deviate from kind of your traditional rules. So the first thing I would want to know, do you guys agree with that? Like, do you think that, well, one, is intuition even a real thing that you could depend upon, or is that more of like a woo-woo concept?
Well, before we get into that, look at like guys like Steve Cohen. Like they claim like on his own trading book, he's never had a down year. Like a lot of that's intuition. Yes, he's got some, help, whatever. But he obviously has great intuition. So, some people are just fabulous traders, right? Able to, an investor is very different than a trader, right? And so I think that traders have great intuition about how to, if you're a bond trader, you're an equity trader, or a commodities trader, like look at commodities. Commodities are very, very, there's no, the fundamentals are more ephemeral there, right, than they are in stocks. And so, what makes oil go up? It's supply and demand. And so you have to understand those dynamics pretty well and inflection points and stuff like that. So
at the end of the day, it's really just kind of subconscious pattern matching. And there's some studies that kind of support this. Like there's this one called the Iowa gambling task. And basically participants are presented with 4 decks of cards, and they draw a card, and that either like adds to their total or subtracts from their total, and they get paid out from it. And some of the decks have these bigger rewards in them, but they're also more frequent penalties to the point where it's a negative expected outcome pull on that deck. And then other ones are positive, but they tend to be smaller. And what they find is that people usually within 40 to 50 polls, they have they're fairly effective at identifying and sticking to the good decks. But what's even more interesting, and that's so they're consciously, they understand like this is the deck I want to pull from. But what's interesting is they'll galvanic skin response, which is basically like a measurement that gets at stress. And people will exhibit stress when they're hovering over the bad deck within 10 trials. So long before it's any kind of conscious sensation, their body actually starts to know that like that's a losing deck before they even know. And I'm curious, do you guys have any like that spidey sense about something, and do you trust it, or like when do you trust it and when do you fade it?
Yes, I think we've been doing this long enough to know. I know my tells. I know when I'm stressed out about certain where it's coming from, and how it manifests in my body. I could feel it. So I do believe in the fact of intuition. If I don't feel like our portfolio is optimal, it's a stress factor for me. Like I don't know if a portfolio is ever optimal, or you never really feel like it's truly optimal. But when you know you're wrong, you feel it. I feel it. I feel it all the time. Yeah. So I do believe in intuition. So
part of the problem is that you get the best portfolio after a long period of underperformance, and so you feel like shit, but the portfolio looks really good, and then the other way around too.
I was going to touch on a slightly different angle, but like, what we try to do is be contrarians, right? And try to look where other people aren't looking, right? And we've been recently pitching this stock to a couple friends, and no one's listening. They're like, I'm not. We even pitched to Eisman recently. He goes, I can't touch that stock, so you'd have to, and you obviously underwrite the stock and figure out that your downside is 10% and your upside's 100. And obviously people won't touch it because it's got some hair around it, or people have had bad memories with it. And so, that's where we feel like that, you got to find these idiosyncratic bets, right? Where there's not a lot of downside. And then, where you can take a big position in something that has 10% downside and 100% upside, right? And that's the way where we try to make, differentiate ourselves, I would say.
There's good news, bad news to that, right? Which is, to me, the good news is because of all of the dynamics of the plumbing of the market, I feel like the market probably, if levels of inefficiency, is probably close to its all-time high, right? Yes. It's inefficiently too expensive in many names. It's inefficiently too cheap in a bunch of other names. The problem is that the majority of capital being run, publicly traded capital being run, are long short-term momentum. So being a contrarian, I think it's extremely difficult to scale to a massive size, right? Like you need super patient capital, outside capital, to deal with, like you said, Tobias, that your portfolio probably feels at its best when after you've had 3 months of like getting punched in the face. That's hard for any outside manager to tolerate and take. That said, there's probably some of the best opportunities, as we know, are names that no one wants to touch if you have some patience and duration.
So there's this book, The Emotionally Intelligent Investor, by this guy, Ravi Mehta. And in it, he talks about 6 items that will help you to determine when you can trust your intuition and when you shouldn't. And his list is, number 1, it's only valuable if it concerns something in which you have ample experience. So you guys, have so much experience that you can start to trust it. And actually in Howard Marks' latest memo that came out this week, he was talking about how he's made 5 market calls over 50 years. And they don't start until the year 2000. And even though he'd been doing it for 30 years at that point. And so he had seen enough patterns to be able to match where your brain can recognize the pattern at that point. And this is Buffett's basic circle of competence, right?
Those inflection points. You're like, that's going to move that stock. I'm confident that with this, if XYZ happens, this stock's going to go and go up a lot.
Yeah,
it's kind of funny. You just brought up Buffett, so of course my head went to a tangent of what he's been doing recently. And you talk about energy, Tobias, that you're knee deep in energy. Everyone doesn't want to touch it. They're worried about a recession, but here's the GOAT, right?
Yeah.
Just made a second acquisition, right? In energy, an LNG facility. I don't know. I would pay attention to what he's doing. I mean, God, I wish someone knocked us on the head when he started buying Japanese commodity.
Oh,
exchange.
yeah.
We did look at it, and we own the Japanese banks, in the very, very early parts of the bull market, but we didn't trust that one.
Right.
30 years of really awful performance is hard to get behind.
Yeah, and financials are an interesting breed. There's such a different characteristics. We just happen to know them fairly well, and perhaps maybe too well when it came to Japan. But like, I just found it interesting. He keeps buying Oxy, and he just made another acquisition. What does he see?
Not much though. 3.3 billion. I agree. Obviously I agree with the thesis, but it's just for him, it's not a huge position.
Yeah.
So a couple other things on this. Number 2, remind yourself of your emotional biases. Number 3, ask whether the investment reminds you of a previous situation where you've been successful. So the more explicit you can be about the pattern match, probably the better.
Yep.
Number 4, know the security and understand your risk reward. Like what you were saying, Porter, it's a 10% downside, 100% upside. Like you still have to do the work, right?
Yes.
Number 5, bounce ideas off of someone else. So that's like courting the outside view, to use Kahneman's term. And then the last one, maintain freedom to change your mind. So set up tripwires in advance that would be like, okay, if this happens, that destroys my thesis on this, and we have to change our mind.
And like when we're bouncing this idea of like off Eisman or off different guys, and a lot of people were like, oh, I can't touch this thing. It's too small. It's too, and we heard all the downsides. We're like, okay, we got it. We know what we're talking about. We got our risk, and we're fine. So yeah, those are great, by the way.
Yeah, I loved all of them. And I feel like whenever we're super successful on name by name basis, we probably employ the majority of those in some way, shape, or form, or even better, avoiding. There were a few things that you said where you avoid some of the names that you've been involved in, or if you see common characteristics of names that you've had mistakes on, you say, all right, get out.
Yeah.
Now,
and, what we like to do is sit down with friends that we know are smart, have a competence in this stuff, give them the 5-minute pitch and see what they say. Are they first of all, that we're all busy people, they have to listen to what you're saying, right? And then if they give you an intelligent response back, like, oh, I can't buy it, that's because my fund is levy, but or whatever, but bounce off, that idea. And if your catalyst is the same catalyst that they're thinking about, that's not the catalyst, right? Because if everyone knows the catalyst is not a catalyst, right?
Right.
You have to, in those big high risk rewards, you have to bang someone over the head like, hey, idiot, we need to buy this stock. This is a big inflection point, so.
Do you agree that the way that the market structure is now, with so many algos, so much systematic nature to it, that the real alpha will be available for a qualitative intuition, sort of like that's where the real money is going to be made now, is when you can catch some pattern that maybe an algo couldn't catch today?
And it usually resides in Contrarian, because almost every single quant I know is long short-term momentum. It's usually at negative to slightly positive inflection points, right? No one's, we all live in the land of misfit toys. Believe it or not, like Meta at one point was part of the land of misfit toys, right? I remember those days. No one wanted to touch this thing.
It was only 12 months ago.
Yeah, it wasn't that long ago.
And so, like, to me, for guys like us, for people like us, that's where the opportunities are going to lie. I don't think we could do what we do in super scale. If you're going to do anything in super scale, just buy the S&P or employ some quant funds that just, and here gets to another point, which is part of the things that make all these things go is the extremely low volatility levels, because almost all of these quant funds are structured on some form of of a volatility targeting construct, right? Somehow, some way, over the last year and a half, given a war, given a raise in 500 basis points, given everything else, the key measurements of volatility have stayed incredibly low.
Yeah.
Yeah. How is that?
Incredibly low, right? So,
Jake, you bring up some interesting concepts of how you look at stuff and recognizing patterns. Well, some of that is screening, right? Well, we do value screening, and then we look at we try to look at every spinoff. We try to look at the big shareholder buybacks. The insider buy. We bought this little bank called Home Street recently, and sure enough, the director's buying $500,000 worth of stock. Stocks went from 30 or 50 to $4, and the director's sitting there buying $500,000 of stock, and all the insiders are buying stock, and I don't know, maybe it's not so bad, right? And so that's the stuff that we look at, right? And where it's the stock has stopped going down, it hasn't gone up yet. So
disclaimer, please do your homework on
100%.
Home Street is quite the volatile beast.
And it could go out of business, but maybe it doesn't.
The Podunk Bank in the Pacific Northwest. We happen to believe they have a hidden asset that is sellable. We'll see, but it is not necessarily for the faint of heart. So
thank you, Vinny.
Why has vol been so muted? Given feels like the rest, there's been plenty of exogenous things that people probably didn't predict, like a war, like inflation.
SVB, the bank failures, regionals.
The Fed papered over a lot of mistakes, right? And then I think that the economy just hung in there. And so, as it hung in and the unemployment stayed low, the vol started collapsing again. And then it's a momentum thing too, right? So.
I also get the feeling that these nouveau zero-dated options, this is above my pay grade, but I just get the feeling that is suppressing vol a lot. But I getting back to the point, the Fed has shown its hand. They'll accept a little bit of malaise or raise rates, but if something materially wrong goes wrong, right, and it shows its ugly face, they bail it out. And I think the market participants have figured that out.
Big time.
Austin Goolsbee, I'm not entirely sure he's on the Fed somehow. But he said,
I think he was Obama's chief economist.
He was, but he's also now a Fed. He's a Fed. I'm not a Fed member. I'm not sure exactly where he's sitting, but
Mandarin?
he said they can manage, they can defeat the business cycle, something like that. They can manage it so there's no more business cycle.
Oh, God.
That was kind of interesting. Like, we've been trying to do that since the invention of the Fed. Nobody's figured it out yet, but maybe this time it's different. Permanently high plateau.
I wouldn't have said that for him, but that's just me.
Well, that's why you're not a central banker.
Exactly.
Yeah, important for confidence to exceed competence to get to one of those sort of positions, I think.
Oh, yeah. Big time.
If we're coming up on time a little bit here, fellas, but if we wind the clock forward 12 months' time, what do you think? Like, where do we get to from here?
Up and to the right. Is that the only?
I think that everyone thinks it's up and to the right. I just think the comps are going to be very tough, right? You've benefited from low inflation, right? And now you have energy coming back up again. You have student debt payments going to start being made. You have higher interest payments that's going to be made. Inflation's ate away, and spending have ate away a lot of this excess savings. So I think you're in for a long slog here, in terms of the economy. What the market does, God only knows. And what China does, I think, is the big engine behind a lot of value stocks. What do they do? Do they stimulate? Do you see copper prices rebound? Do you see iron ore prices rebound and all that type of stuff? I think that's the big wild card out there. But I know the economy I don't think is going to be all that great.
The only thing I would add is that 12 months from now, we're going to be talking every day about the presidential election cycle, right? So that is going to be, I know we could tune it out probably for another, what, 4, 5, 6 months probably. And as we turn the calendar, we probably can.
But the stim is going to be there.
That's where I'm getting at, Porter, is that I actually think we'll probably get more stim than people think, simply because President Biden has shown his hand that he didn't give a rat's tail about fiscal deficits, or the one thing he knows how to do is win an election, and you're not going to win an election on austerity, right? So I expect a hefty amount of handouts coming over the next year, where probably be in similar places, the IRA, the CHIPS Act, some form of more abatement in student lending, moratoriums and the like. But I expect a heck of a lot of political rhetoric impacting markets next year.
Bread and circuses.
Yeah.
Yes.
Yeah.
100%. Not a new concept, Jake.
Thanks so much.
Not a new concept.
Thanks so much, gents. Well, it's always a pleasure to chat with you guys. Vincent, Daniel, Porter Collins from Seawolf Capital. If folks want to get in contact with you, follow along with what you're doing, what's the best way to do that?
Twitter's probably, I'm at Seawolf Cap.
And I'm at VD718. Yeah, we're on Twitter a lot. Just give us a holler. We love chatting. So
thanks, JT. JT and I'll be back next week.